When it comes to investing, boring, stable companies are my favorite to invest. And waste management, it is definitely as boring as it can get. Looking at the company's profile, Waste Management, through its subsidiaries, provides waste management environmental services to residential, commercial, industrial, and municipal customers in North America. It offers collection services, including picking up and transporting waste and recyclable materials from where it was generated to a transfer station, material recovery facility, or disposal site, and owns, develops, and operates landfill gas-to-energy facilities in the United States, as well as owns and operates transfer stations. As of December 31st, 2021, the company owned and operated 263 solid waste landfills, 5 secure hazard waste landfills, 103 MRFs, and 348 transfer stations. It also provides material processing and commodities recycling services, recycling brokerage services such as managing the marketing and recyclable materials for third parties, and other strategic business solutions. In addition, the company offers instructions and remediation services related with the disposal of fly ash and residue generated from the combustion of coal and other fuel stocks, and plant services comprising full service waste management solutions and consulting services, and specialized disposal services for oil, gas, and gas exploration and production operations. With a current price of $160.23, up this week of almost 2% at 1.73%, does this company's fundamentals match this ticker price? We're going to find out. Hi there, everybody. Welcome to another stock analysis video. We are going to be analyzing by far one of my most favorite companies out there. Super boring. They pick up trash. They have like no issues, at least not anymore. They have no issues when it comes to, I guess, scandals. Waste Management Incorporated. Coming over here to the dividend summary, they have a dividend yield of 1.44%, which ends up being 58 cents a share, with an annual payout of $2.30, payout ratio of 47.35%. In regards to net income, 5-year growth rate of 7.05%, a dividend growth of 18 consecutive years, which is really good. They're getting up there to almost being a dividend aristocrat. Ex-dividend date of September 2nd already passed, payout date of September 17th already passed, and they pay out their dividends quarterly. Coming over here to the calculator and inputting the ticker symbol of WM, share price of $160.23, PE of 38.97. We would like this to be under 20, so this is already screaming very expensive. Market cap of $67 billion. Now, coming over here to the growth assumption, I'm going to assume a 5% growth assumption. In Seeking Alpha, they actually have a revenue growth year over year of 15.5%. Now, obviously, you can put 15% if you so wish in this calculator, which I have made available in my AT&T video. So if you would like to have this calculator, make sure to visit that video and click on the link. It is there. So if you want to try and see what kind of price you get with 15%, then by all means do so. I'm personally going to put 5%. Now coming over here to the metrics, we got the net income 2016, 1.2 billion to 2020 of 1.5 billion. That is an increase of 19%. Now, obviously in 2017, 2018, they actually had really good years, whereas 2019 and 2020 it has gone down. However, I do project this to be positive in the next coming years. Just the fact that it is a garbage company, and by that I mean that it's not a bad company, it's just that it's a garbage company. Since I don't believe that we're never going to stop having trash, I think that they're going to be doing pretty well within the next 4 years. Next, we got the free cash flow, 1.7 billion to 1.8 billion. That is an increase of 6% with an average 5-year free cash flow of almost $2 billion at $1.8 billion. Next, looking at the revenue, their revenue charts looks very steady. 2016, 13.6 billion to 2020 of 15.2 billion. That's an increase of 10.57%. Next, looking at total debt, obviously we would like for this to be decreasing, and unfortunately it is not. 9.3 billion to 13 billion. That's an increase of 35%. Next, we got the shares outstanding. quite possibly the most overlooked and most important metric to look at, because this tells you if the company is diluting you or are they giving you a bigger piece of the pie. We got 439 million shares 2016 to today of 418 million shares. They are buying back shares at a rate of 5%, which is really, really good to see. And lastly, we got cash and equivalents, and their cash and equivalents looks pretty weak, not gonna lie. Their best year was in 2019 where they had $3.6 billion in cash and equivalents. However, today they only have 116 million. Their average cash and equivalents is about $724 million. And now with all of that, we get a target share price of $85.55, assuming a 5% growth rate. Adjusting for debt, however, this goes up to $118.48 with a margin of safety of 5, 10, and 15%. We would ideally like to buy this at $112.56, $106.63, and $100.71. So this has to drop by a lot, about $60 to buy it at the margin of safety of 15%, and around $40 to buy at a target share price at $118. Now, that might seem like a lot. However, prices tend to match their fundamentals. Either the fundamentals need to go up to match the ticker price, or the ticker price needs to come down to match their fundamentals. With a PE of 38.97, the fact that this needs to drop $40, roughly $42, tells me that this calculation is in the right ballpark. Now, looking at the dividend, we're going to see if they can actually even afford this dividend. As y'all saw, annual dividend per share is $2.30. The amounts paid every single year is $962 million, where after they pay this dividend off, they still have $845 million in free cash flow. So cutting it close, not a lot left, but they can still pretty well afford it. And that is a payout ratio of 53.22%. Ideally, we would like to get this at 60. So the fact that they are at 53, that is really, really solid. All in all, this company, in my opinion, is just overvalued. All other metrics look pretty good. They can afford their dividend. It just needs to drop a couple tens of dollars so that way it can look appealing to buy. That pretty much does it for this episode. Like, if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble if you want to catch some exclusives. And with that said, peace out everybody, and be on the lookout for the next stock analysis video.